What I have learned from studying markets, debt behavior, and the long arc of financial history is that most people do not fail because they lack ambition. They fail because they do the right things in the wrong order. That is a simple idea, but it is one of the most important principles in building wealth. I see people every day who are excited about stocks, excited about crypto, excited about some new fund, excited about whatever asset class is being discussed on television or online. And then when you look at the whole picture, you find something very different. You find credit card debt charging them more than 20%. You find no emergency reserve. You find an employer offering them free matching money that they are not taking. You find tax-advantaged accounts sitting unused. So they are trying to build a portfolio while the foundation underneath them is cracked. That is not investing, that is disorder. And disorder, when applied to money, compounds against you. Think of it like trying to fill a bucket that has holes in the bottom. You may be pouring water in as fast as you can, but if the holes are large enough, the level never rises. The person looks busy, the person feels responsible, the person says, I am investing. But the system is leaking faster than the inflow can repair it. That is what high-interest debt does. That is what lack of emergency liquidity does. That is what poor tax planning does. The order matters, the sequence matters. The machine matters more than the single investment. Most people want to skip directly to the exciting part because the exciting part is where the story feels like it begins. They want to know which stock to buy. They want to know whether the market is going up or down. They want to know whether artificial intelligence will change everything, or whether crypto will recover, or whether real estate will crash. Those questions may matter later, but they do not matter first. The first question is not what asset should I buy. The first question is what is the correct order for putting my next dollar to work. That is a very different question, and it produces a very different kind of investor. An investor who understands sequence does not act like a gambler at a slot machine. He does not put money somewhere simply because the lights are flashing. He looks at the full system and asks, where does this dollar produce the highest risk-adjusted result after accounting for debt, liquidity, taxes, behavior, and optionality? That is how I think about it. If you want to build wealth, you must think in systems. And if you think in systems, you learn that the boring foundational decisions are usually the most powerful. There is data that should make every ordinary household pause. A very large share of Americans do not have a real emergency fund. Many people have only a few $100s saved for emergencies. That amount is often less than a car payment, less than a medical bill, less than the cost of one serious repair, and yet many of those same people are trying to decide whether to buy individual stocks or speculate on digital assets. That is backwards. It is like asking whether you should buy a Ferrari when your current car cannot survive a flat tire. It is not that investing is bad. Investing is essential, but investing before you have basic financial resilience can turn a normal emergency into a forced liquidation. That is one of the great hidden dangers in personal finance. It is not just that you might lose money in the market, it is that you might be forced to sell a good investment at a bad time because you never built the cash buffer that protects you from life. Markets do not care about your timing needs. Life does not care about your portfolio plan. A job loss, a medical bill, a broken furnace, a car repair, a family emergency. These things do not arrive when markets are convenient. They arrive when they arrive. That is why the first step before a person tries to optimize returns is to establish liquidity, not maximum liquidity, not a giant pile of idle cash forever. A sensible emergency reserve. The purpose of an emergency fund is not to make you rich. The purpose is to stop you from being forced into decisions that make you poorer. It is a shock absorber. It creates room between the event and the reaction. When you have no emergency fund, every surprise becomes a crisis. And when every surprise becomes a crisis, you borrow at bad rates, sell assets at bad prices, and make emotional choices. That is how people who are trying to build wealth keep getting pulled back to zero. Many advisors will say that a person needs 3 to 6 months of expenses. That is a reasonable range, but it is too broad to be useful without context. A person with a stable government job, strong benefits, low fixed expenses, and a second income in the household does not have the same liquidity need as a freelancer in a volatile industry with dependents and no benefits. The principle is to match the reserve to the fragility of your income and the volatility of your life. But for most people, the practical path starts smaller. Build the first $1,000 as quickly as you can. That amount will not solve every problem, but it creates a first layer of protection. Then build to 1 month of living expenses, then build to 3 months. Once you reach that point, you can decide whether your personal risk requires more. This is how you make an overwhelming goal manageable. You do not stare at the mountain and freeze. You build the first ledge, then the next one, then the next one. There is also a psychological benefit to this. When a person has even a modest emergency reserve, he behaves differently. He is less panicked, he is less reactive. He is less likely to put a surprise expense on a credit card at a terrible interest rate. He has a small amount of control in a world where control is often the most valuable asset. The numbers matter, but behavior matters too. A financially fragile person makes decisions from fear. A financially resilient person can make decisions from principle. That difference compounds. Once the emergency fund is in place, the next priority is high-interest debt. This is where many people get the order completely wrong. They want to invest because investing feels like progress. But carrying credit card debt at 20% while trying to earn 8 or 10% in the market is not progress. It is a negative spread. You are borrowing at a rate higher than the realistic return on the asset you are trying to buy. That is not smart leverage. That is leakage. If you have a debt charging you more than roughly 8%, and especially if it is credit card debt above 20%, paying it down is usually one of the highest return investments available to you. And unlike the stock market, the return is guaranteed. If you pay off a balance charging 22%, you have effectively earned a 22% return by eliminating that cost. Most investors in history cannot produce that consistently. So if you are carrying debt at that kind of rate and you are trying to pick stocks at the same time, you are not being aggressive, you are being undisciplined. The system is working against you faster than your portfolio is likely to work for you. A simple example makes this clear. If a person has $5,000 in credit card debt at roughly 22% and only makes small payments, the interest can consume thousands of dollars over time. That money could have been compounding for the person instead. It is compounding for the bank. Debt at high interest is a machine. It does not need you to believe in it. It does not need you to think about it. It works every day. And if it is working against you, then you must shut that machine down before you build a more advanced machine on top of it. The best method for paying down this kind of debt is usually the debt avalanche. You list every debt. You identify the interest rate on each one. You pay the minimums on everything. Then every extra dollar goes to the debt with the highest interest rate. That is the mathematically efficient approach. Some people prefer the debt snowball, where the smallest balances are paid first for psychological motivation. That can work for people who need early wins to stay committed. I do not dismiss psychology because people are not spreadsheets. But from a pure economic perspective, the avalanche saves the most money. The deeper point is not the label. The deeper point is that high-interest debt must be treated as an emergency. Not because the creditor is calling you every day, because the math is bleeding you quietly. But there is one important exception to paying down debt before investing, and that exception is employer matching money. If your employer offers a retirement plan match, that match is often the closest thing to free money that exists in an ordinary financial life. If your employer says that when you contribute $1, they will contribute another 50 cents or another dollar up to a certain percentage of your salary, that is an immediate return that almost no other investment can match. That is why, even if you still have high interest debt, it often makes sense to contribute enough to get the full employer match. Not more than necessary at that stage. Just enough to avoid leaving that guaranteed return on the table if your employer matches 50 cents on the dollar up to 6% of your salary and you do not contribute enough to capture it. You are voluntarily declining compensation that was already part of the system available to you. Many people spend enormous energy trying to find a stock that might rise 50%, while ignoring a guaranteed match that may be sitting in their benefits package. That is a failure of sequence. It is also a failure of attention. The match comes before the exciting investments because it is a high probability return with a simple mechanism. You contribute enough to capture the match, then you redirect the remaining extra cash back toward eliminating high-interest debt. Once that debt is gone, you can increase contributions. There is one detail to understand. Some employer matches have vesting schedules. That means you may need to remain at the company for a certain period before the employer contribution fully belongs to you. That matters. But even with vesting rules, the match is often too valuable to ignore at this stage. If you have an emergency fund, you are paying down high-interest debt, and you are capturing the employer match. You have done something most people never do. You have created the foundation. You have stopped the worst leaks. You have captured the obvious guaranteed money. Now you can move into what I think of as the tax optimization layer. This is where the order becomes less obvious to many people. A lot of people jump into taxable brokerage accounts because they are flexible and easy. They can buy anything, they can trade anytime, they can see the account grow on an app. But flexibility does not always mean efficiency. In a taxable account, dividends can be taxed. Realized gains can be taxed. Every time money is thrown off or an investment is sold at a gain, the tax system can take a piece of the compounding engine. That does not make taxable accounts bad, it means they usually come later. Before you use taxable accounts heavily, you want to use the accounts that give you tax advantages. Because taxes are one of the largest frictions in the wealth-building machine, the next step after the foundation is usually an individual retirement account. The reason an IRA often comes before increasing 401k contributions beyond the employer match is control. Many employer 401k plans have limited menus. Some plans are excellent. Some plans are filled with expensive funds and poor choices. An IRA often gives a person access to low-cost index funds and ETFs with much broader choice and lower fees. Fees sound small, but over long periods they are not small. A 1% difference in annual fees may look harmless in 1 year. Over decades, it can move tens of thousands of dollars from your pocket to someone else. That is why serious investors think in basis points, expense ratios, and tax drag, not because they are obsessed with details, but because the details compound. For 2025, the contribution limit for an IRA is $7,000 or $8,000 if you are 50 or older. Those limits may change over time, but the principle does not. Use the tax advantage space available to you before you build heavily in a taxable space. Then comes the decision between traditional and Roth. This decision is often made too emotionally. People hear that Roth is better because tax-free income in retirement sounds wonderful, or they hear that traditional is better because the deduction today feels good. The real question is simpler and more structural. Do you want the tax break now, or do you want it later? A traditional account gives you a tax deduction today, but withdrawals are taxed later. A Roth account requires you to pay tax now, but qualified withdrawals later are tax-free. The answer depends on your current tax bracket, your expected future tax bracket, your income trajectory, and your view of future tax policy. If you are young and earning less today than you expect to earn later, Roth often makes sense because you may be paying taxes at one of the lowest rates you will ever face. If you are a high earner in peak income years and expect lower taxable income in retirement, traditional contributions may make more sense because the deduction today is more valuable. But nobody knows future tax rates perfectly. Nobody knows exactly what Congress will do decades from now. So for many people, a mix of traditional and Roth creates tax diversification. It gives options in retirement, and options are valuable when the future is uncertain. This is how I think about financial planning. It is not about pretending you can predict everything. It is about building a system that can function under multiple possible futures. If you have access to a health savings account, this is where the system becomes especially powerful. Most people underappreciate HSAs because the name makes them sound like a narrow medical account. But an HSA can be one of the most powerful tax-advantaged vehicles available to a person who qualifies. It has 3 tax benefits. You can get a tax deduction for contributions. The money can grow tax-free, and withdrawals for qualified medical expenses can be tax-free. That combination is rare. It is one of the few places in the financial system where money can receive tax benefits going in while it grows, and when it comes out, if it is used properly for 2025. The contribution limits are $4,300 for individual coverage and $8,550 for family coverage. The eligibility requirement is that you must be enrolled in a qualifying high-deductible health plan. That is not right for everyone. If you have high ongoing medical costs, the health plan itself may not be suitable. But if you are eligible and the plan fits your situation, the HSA deserves serious attention. The most powerful strategy is not necessarily to spend HSA money immediately. If you can afford to pay current medical expenses out of pocket, you can leave the HSA invested and keep your receipts. There is no time limit on reimbursing yourself for qualified medical expenses under current rules. That means a person can pay a medical bill today, allow the HSA to compound for years, and reimburse that expense later tax-free. That is a powerful mechanism. It turns medical expenses into a kind of future tax. Free withdrawal capacity after age 65, the HSA becomes more flexible. Non-medical withdrawals are taxed like a traditional retirement account, but medical withdrawals can still be tax-free, and medical expenses in retirement are not a theoretical risk. They are highly likely. A large share of retirement costs often comes from health care. So a well-funded HSA is not just a health account, it can be a retirement resilience account. It protects against one of the most predictable and expensive liabilities of aging. This is why order matters so much. A person who rushes into taxable investing before using an HSA may feel active, but they may be leaving a uniquely efficient vehicle unused. Once the IRA and HSA are being used effectively, the next step is to return to the employer retirement plan and contribute beyond the match. This is where the 401k becomes a larger engine. For 2025, the contribution limit is $23,500 for most people, or $31,000 for those 50 or older. When you combine an IRA, an HSA, and a 401k, a disciplined saver can shelter a very meaningful amount of income from immediate taxation or create significant tax-free growth potential depending on account type. That is not glamorous. It is not the sort of thing that produces a viral headline, but it is how compounding is protected. Most people never reach this stage. The average household saves too little to fill even the early parts of the sequence. That is why those who do reach this stage are already in a different category. They have moved from reaction to design. They are no longer just trying to survive the month. They are constructing a machine that can carry money through time with less friction. That is what wealth building really is. It is the process of reducing unnecessary friction and increasing productive compounding. The emergency fund reduces behavioral friction, debt elimination reduces interest friction, employer matching increases immediate return. IRAs and HSAs reduce tax friction, 401k contributions increase scale only after those pieces are addressed. Do taxable investment accounts become the next logical step? And taxable accounts are important. They are not the enemy. They are simply not usually the first priority. A taxable brokerage account gives flexibility. It has no contribution limit. It has no retirement age restrictions. It can be used for early retirement, a house down payment, a business opportunity, education, or any goal that does not fit neatly inside a retirement account. That flexibility has value, but the cost is tax drag. Dividends may be taxed. Capital gains may be taxed when realized. Frequent trading can create unnecessary tax bills. Poor asset location can make a good investment less efficient. So the right way to use a taxable account is not to treat it like a casino. It is to treat it as a flexible extension of the broader system, low turnover tax. Efficient investments often fit better there. Long-term holdings often fit better than constant trading assets that throw off large taxable income may be better placed in tax-advantaged accounts when possible. Again, the details depend on the person, but the principle is consistent. Put each asset in the place where it works most efficiently. That is system design. A taxable account can also become the bridge for early financial independence. If someone wants to retire before standard retirement account access ages, taxable assets can fund the years before retirement accounts become available. They can also receive a step-up in basis under current estate rules, which can matter for legacy planning. That is why taxable accounts are powerful when used in the right order. Not first, not instead of the foundation. After the foundation, the sequence then is clear. Build an emergency fund, eliminate high-interest debt, capture the full employer match. Maximize the IRA where appropriate, use the HSA if you qualify and it fits your health plan needs, return to the 401k and build beyond the match, then use taxable accounts for flexibility, early retirement, and additional wealth building. This order is not exciting because it does not promise a miracle. It promises something better. It promises that each dollar is being placed where it has the highest structural advantage at that stage. Most people underestimate the value of avoiding mistakes. They think wealth is created by heroic decisions. Sometimes it is. But for most people, wealth is created by not doing the obvious wrong things over and over again. Do not invest while ignoring a credit card balance that is compounding against you at 22%. Do not leave employer matching money on the table. Do not let taxes take more than necessary because you skipped the accounts designed to reduce them. Do not build a portfolio that you will be forced to sell the moment life produces a surprise. Do not confuse activity with progress. These sound simple, but simplicity is not the same as weakness. The best principles are usually simple because they must hold under pressure. The markets will always offer a new temptation. There will always be another asset, another forecast, another person saying this is the moment, another fund, another opportunity, another crisis. If you do not have an order of operations, the noise will control you. If you do have an order, the noise becomes less powerful. You know what the next dollar is supposed to do? You know which hole in the bucket must be repaired before more water is poured in? You know when to prioritize protection, when to eliminate leakage, when to capture guaranteed returns, when to reduce taxes, and when to seek flexible growth. That is not just financial planning. That is decision architecture. And decision architecture is what separates people who are reactive from people who are strategic. I have spent my life studying systems, and one of the main lessons is that outcomes are often determined less by single choices than by the structure that produces those choices. A good system makes good decisions easier. A bad system makes bad decisions inevitable. If your system is that you invest whatever is left after spending, you will probably not build much wealth. If your system is that you chase whatever looks exciting, you will probably buy high and sell low. If your system is that you pay the loudest creditor, respond to the latest headline, and hope the market saves you, you are not in control. But if your system allocates each dollar in the proper sequence, then the machine begins to work for you. First, it protects you, then it stops the bleeding, then it captures free money, then it reduces taxes, then it compounds, then it expands flexibility. That is the order, and the order is powerful because it matches the hierarchy of risk. Liquidity risk comes first, high-interest debt risk comes next. Missed guaranteed return comes next, tax friction comes next, then market growth. People reverse this because market growth is more interesting, but the market will still be there after you build the foundation. The question is whether you will still be standing when volatility comes. That is why I would rather see a person build slowly in the right order than rush quickly in the wrong one. The person who builds in the right order may not feel rich immediately, but month after month, the system becomes stronger. The emergency fund grows, the debt shrinks, the employer match is captured, the IRA begins compounding, the HSA becomes a future health care reserve, the 401k grows, the taxable account becomes an optionality pool. And eventually, the person looks up and realizes that the financial life has changed, not because of one brilliant trade, because the architecture was correct. Most people do not need a more complicated strategy. They need a better sequence. They need to stop asking what is hot and start asking what comes next. The next dollar has a job. Do not let emotion assign that job. Use principles, use order, use the system. That is how you build wealth in a way that can survive reality.